How can advisors ensure that their clients' portfolios remain robust to shifts in the economic landscape? Hi, I'm Joe Davis, and today I'll talk about managing duration risk in a fixed income portfolio, as well as thinking about emerging opportunities in the equity market that extend beyond the large cap growth stocks. The performance of the Magnificent Seven stocks and the tech sector in general have really powered the U.S. stock market in 2025. Great news for investors. Key question though, what do I do now? And ironically, I think there's an environment today in the next quarters ahead where you can play both offense and defense, which means you don't have to pick a side. If you're optimistic on AI, think about how it starts to spread in that technology spread. We go from production to consumption. That's for stocks, investment opportunities outside the technology sector. Areas that have trailed, such as value-based companies, even perhaps small cap companies. If, however, you want to play defense because you think there's some hype in AI and markets are extended, you can think about the same strategy. You can also think about going a little bit into the value space, small cap space, which don't have those high valuations before. And of course, you could also invest in fixed income in an overweight position. So offense, defense, same strategy in a forward-looking basis. Well, I certainly understand some investor concerns when they hear high deficits and the interest rate rise that we've had over the past several years. What's the role of fixed income? Should I be in high duration instruments? Our view is fairly constructive on fixed income for two reasons. The first is, for the first time in a long time, investors are being compensated for higher deficit levels, for the higher interest rates from the Federal Reserve, what some technically call a term premium. But the fact is that by our estimates, the 10-year Treasury yield, other parts of the Treasury market, interest rates are above what's so-called fair value range. And so investors are being more than compensated for the headlines that they may see, from quarter to quarter on some of the deficits in the macro environment. And the secondly is around diversification. Fixed income can always provide diversification for client portfolios, but particularly in an environment of heady valuations in the U.S. equity market. If we do have a downdraft in the economy, it is not our baseline of a recession or a close to recession. But the fact is that we've had some significant weakening in the labor market. And so from a risk diversification perspective, I would argue there's certainly more risk in the equity market than in the fixed income markets. So the takeaways in my mind are clear, and that is a significant role for fixed income, both on a strategic basis as well as on an environmental basis, for two reasons. Again, higher income today than we've had in arguably over a decade, and in our judgment is unlikely to change anytime soon. And secondly is some growing risk in the equity market. So again, higher income and also risk diversification point to a strong role for fixed income, high quality fixed income in the quarters and years ahead. Be sure to like this video and subscribe to this channel to hear from Vanguard thought leaders.